Thanks.
Got hour and a half. We can keep that.
Okay.
You say I'm going to have to leave early to catch a plane, but I certainly enjoy meeting all of you. Very nice weekend too. A lot of fun and exchange of ideas. Always like this kind of experience.
Good fun.
For those of you on the internet, David just mentioned that he needs to leave a little bit early, so everybody just gave him a second round of applause here. Did I see a standing ovation here? No. Yeah, I would. Come on. This guy is amazing. All right, that's good. Yep, okay. Several people asked me, how do I get good at this stuff? I mean, I can see how Gary Follett talks about things, how I talk about things, how David talks about things, Tom Williams. Everybody's got a little bit of a different take on things, but we're all sort of singing from the same song sheet. And, gee, how do you really do it? And so I'm going to just digress a little bit off of my prepared presentation and just talk about a book that I picked up the other day. It just got published in April, and it's called Bounce, B-O-U-N-C-E. And the subtitle is Mozart, Federer, Picasso, Beckham, and the Science of Success. And it's written by Matthew Syed, who's a Brit. He was the table tennis champion of Great Britain, ping pong champion. It's an excellent book because a lot of what we think about in terms of talent, whether we're talking about Tiger Woods or David Weiss or Tom Williams, we look at their skills and we look at how David can read the chart and we say, my gosh, that's amazing that he can see what he can see in that chart. But it's a skill that's developed. It has nothing to do with, he wasn't born able to read a chart. He wasn't, he's a very bright man, no question about it, but it's not because he's got a high IQ. It's not because of his genetic heritage in any way. Now, we all believe that. We all believe that Tiger Woods must have the golf gene, right? Or Larry Bird had the basketball gene. But it's not true. That comes out of, Darwinianism and Francis Galton, and I won't go into that. But 35 to 40 years of good, solid psychological research in mastery and excellence. In case those of you who don't know, I am a psychologist as well as a trader. But 35 to 40 years have proven time and time again that it's not about genetic makeup. It's not about IQ. It's not about anything that anybody brings to the table except for a really strong desire to learn a skill and to really put the practice in. We call it deliberate practice or deep practice or purposeful practice. Now, we all, you might have heard that it takes about 10,000 hours or maybe about 10 years to develop mastery in a given subject. And that's about true. I mean, we've seen that in the research over and over and over again, whether it is a trader having the skill set of reading the market, or a top neurosurgeon, or a ping pong player like Matthew Syed. Doesn't matter what the skill is across all those different disciplines. It's always the practice that one puts in. And it's always a practice in a purposeful way to really learn, to really sort of take yourself and push yourself beyond the edge of the envelope, falling and failing, failing and falling, failing and falling, but eventually getting it. And this is the tried and true route of anybody who makes a tremendous success of themselves. Okay? Whether you're an Olympic athlete or a top lawyer, top litigator. It's the same story. It's the same path to success. So I just wanted to mention this because people say, well, how do I get good at this? And the truth is that you really need to practice it. Go through charts, do bar-by-bar replay, paper trade. Go back through historical data, and just set it up and go through it. And try to understand what's going on each of the bars or each of the waves, some of the things that we've all been talking about, and keep doing it over and over and over again. Here, for example, there was a wonderful study done, and I often talk about this, of two groups of Olympic skaters, Olympic-level skaters. One group that was Olympic level, the other group almost Olympic level. Okay? What do you think the differences were, or the difference was, it's one difference, between the two groups of Olympic-level elite figure skaters and almost elite figure skaters? Anybody have an idea? Pardon me? Belief. Partly belief, but not the overriding. Practice time is getting close to it. But here's the interesting thing. Let me just tell you a little bit about these two groups. Ages were about the same. They were both about the same age. Family background in terms of ethnicity, socioeconomic status, about the same. Okay? They all came from roughly the same kind of neighborhoods. Gender, male versus female, about the same. No significant difference there. Okay? Coaches, exactly the same. They were both being coached by the same coaches, both groups. Practice time, before I get to that, the amount of time skated, about the same. However many years it was, they both had about the same level of time put in on the ice. Current practice time, about the same. They're both putting in the same number of hours on the ice. What's the difference? There's a wonderful study. Yeah, exactly. The quality of the practice. The folks who were the Olympic level would try to do the triple sow cow. And I'm not a figure skater, and I apologize to anybody who is a figure skater and is listening to me or looking at me and saying, what is he talking about, triple sow cow? Whatever the hard jumps were, whatever the hard moves were, these skaters would get out on the ice in the morning at 4 o'clock in the morning when they had ice time, and they would do the triple sow cow, try to do it, fall, bang themselves up, go into the whirlpool at the end of the day, put the ice packs on, go to bed, get up the next morning at 4 o'clock, get out there, do the same darn hard work on the triple sow cow. Fail, fall, whirlpool, ice pack, get up the next day, get out there, triple sow cow, fail, fall, over and 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 over again until they got it. That's the difference. Now, I'm not suggesting that we have to do that level of practice to get ourselves to the point where we're competent as traders. There's competency and then there's mastery. David's been doing this for 35, 40 years and has developed that level of mastery by putting in that kind of deliberate practice, that purposeful practice. But that's really what it takes. The more purposeful you can be in your practice, the quicker you're going to get to the point where you can read this stuff real time and read this as the market's unfolding. Just to give you an example, the level of experience that we have has little to do with our level of competency. We're all, for example, drivers here in the United States, right? We all have been driving for years and years and years, most of us who are 40, 50 years old, 35 years old. We've all been driving for at least 15 or 20 years, yet very few of us, if any of us in this room, are professional drivers and could take a car and drive it on a track or in a course on a professional level. But yet we put in all the... What's the difference? What's the difference, do you think? When we're driving, we're listening to the radio, we're talking to somebody else, we're thinking about other things. We're on autopilot. Psychologists call this automaticity. In other words, we're just kind of going through the motion, not really paying attention to what we're doing. Yeah, if a car comes out and comes into our lane, we're going to be able to react. We have enough mindfulness to be able to do that, but we're not purposefully attending to the tasks at hand of driving. That's the difference. When you're sitting in front of your chart and you're practicing, don't just go through it in a rote, kind of mindless way. Be purposeful about it. Be deliberate. Get something out of it each time. Stretch yourself. And that's how you acquire a skill like this. Okay? So, just wanted to do a quick little, because so many people came up and asked me that question. And again, Bounce by Matthew Sayed. Excellent book. 2 other books on this same topic. The Talent Code by, I forget his first name, I think the last name is Colvin. And the other is called Talent is Overrated. All 3 books talk about the same deliberate practice phenomenon and do it in a little bit different way. They're all really good. This has just been published, and it's an excellent book, Bounce. All right. So let's go on to more about Wyckoff. So yesterday, we had a pretty good session, I thought. We talked about Wyckoff's case study, as I refer to it, of the 50 stocks in the New York Times moving average. And we are going to continue to do that today. We had talked yesterday about the rally off of the selling climax, and we talked about all the different components that we would look for in a rally, right? Remember, we talked about volume coming into the upside, retracing or diminishing on the reactions. We talked about volume off the bottom a little bit. We talked about absorption. We talked about a number of different things. And we ended right near the top of this rally. And so today we're going to focus on the downside. Okay? And we ended yesterday right at bar number 1 on this chart. Can everybody see that okay? Yeah, okay. So Wyckoff talks about this in his section 7M of the original course. And I made this offer to folks, and I'll make this offer to everybody here too, including the folks on the internet. If you're interested in getting a copy of a PDF file of the original section 7M, along with the hand-drawn charts, drop me an email, and I will be happy to send you a copy of that. Okay? All right. Bar number 1. We have the highest volume on the chart, or nearly the highest volume on the chart. And Wyckoff talks about this. We see a little bit of an acceleration in the trend here, and we get the highest volume, and we get a close in the middle, sort of the first indication that all is not in keeping with the bullish move. Again, we're talking about effort versus result, right? Tremendous amount of effort in the volume on bar number 1, and yet the result, we should see perhaps a wider spread or wider range up, but certainly a stronger close than this. The very next bar, bar number 2, we see it as a down bar. And actually, bar number 2 and bar number 3, both of these bars, sustained volume on the downside. We see 2 bars here, particularly bar number 3. We actually get an increase in volume to the downside. Wyckoff called this a change in behavior. Why? Because every single reaction in this uptrend, up to this point, we see volume recede on the reaction. And I highlighted those in A with these, right? As the first bars coming down after a good rally, and we see volume immediately recede. Everybody see that? And yet on bars number 2 and number 3, volume doesn't recede at all, does it? Subtle, but very telling. This is the beginnings of distribution. This is clear evidence of distribution on these charts, or on this chart. On bar 4, the same thing. Volume recedes a little bit, but it's sustained. It's still very heavy volume on the downside. What do you make of bar number 6 here? What do you all think about that? How would you describe this bar, and what do you think it means? Wide range to the downside, right? Wide spread to the downside. What does it mean? What's the significance of this bar? Go ahead. It's confirming the selling. Yeah, exactly. We're seeing here, remember David talked about the biggest range or biggest spread down bar in an uptrend and vice versa. Here's what we're seeing. We're seeing that this is the largest down bar since the uptrend began. And Wyckoff called this the breaking of the backbone of the rally. Because supply here, David calls this supply swamping demand. That's what's occurring here. Supply is overcoming demand. Okay, everybody see that? And then we come down to this level. I've drawn a small horizontal support line where there was some support of the market back in mid-February of 1931. Okay? And Wyckoff described this as we're coming in and we're coming down pretty hard here compared to the rally coming up and compared to any prior reaction. And in fact, we're getting a little bit oversold, and we're coming into an area that had been supported before. So we might expect to see a rally from here. Okay. Oops, I think I just exited out of the screen. Sorry about that, folks. I just turned it back on. Let's take a little closer look at this. David just showed you a wave chart. And this is kind of the same concept without putting the zigzag on. Again, this is the 1931 market. But you can see on each, I've highlighted these in green, on each of the reactions, you can see the volume pretty minimal, right? On each of the reactions. We get a little more volume here, but still pretty minimal. And look at the volume on here. If we were to do an average of, not to say that we should be, filtering this by averages, but just as a different way to think about it. If we were looking at the average of volume here, we would see something maybe like this, and perhaps this one would be a little bit higher, but it would be down in this area somewhere. If we took an average on this wave coming down, look at the volume here. It's probably twice the amount of volume on any prior reaction. If we had David's wave chart, we'd actually be able to measure that much more carefully or much more fully and see it. All right? Everybody see that? Any questions about that? This is supply coming into the market. This is supply swamping demand. Here is a chart of, looks like IWM. Yeah. The ETF for the Russell 2000 on a daily basis. And this is the volume on the July 2007 reaction before the final rally up and the tremendous bear market that we had throughout 2008 and into the first quarter of 2009. You see the volume here on this wave coming down compared to anything else on this chart. It's the highest volume that we have, and it's all coming into the downside. Okay? Now, obviously, we've also broken down below the lows here, right? And we can even say that earlier here we have, whoops, kind of squiggly line here, but this is also very large volume to the downside as a precursor here. Okay? We're starting to see that even earlier on. Markets don't turn on a dime. They take time. And this took some time to turn. But this is now on a weekly basis. We're looking at, I just compressed the data just so that we could see it a little bit easier. Okay? And we could see the effect of this downside volume here, this supply coming into the market. Notice that as we rally back up, it's what I would call kind of a lackluster rally. We don't get really good movement up. Volume is lackluster as well. It's lower. And as we get closer to the top, notice that the volume is diminishing. And then we fall and into the October-November cascade here, waterfall effect. Everybody see that? This is a way we were watching this high volume coming in, and we were saying, oh my goodness, that's an incredible amount of volume, knowing that this was the potential for that kind of supply coming into the market. Okay. Any questions on that? It's just a different way to look at it. Make sense? Okay, good. So back to the 1931 market. We left off at bar number 1 here. We had come down to this support level. We said we were getting a lot of supply coming in, but we're getting a little oversold here on this push down. And so we would expect a rally. And we do. We start up the very next day on bar number 2. And we have, again, as we go up, a fairly lackluster rally. Look at the rally here. Okay? And I've highlighted that in red, this red box. Compare that with the rallies up to the high and the prior rally even, up to this level. And I highlighted those. Is this volume at all in keeping with those prior rallies? No, right? So what do we have here? We have increased volume to the downside for the first time since this rally began way back in December. And now as we try to rally up, buyers are just not following price up any higher, are they? And we're seeing that in not only in the price, and in terms of the price bars, where we had nice, as David calls it, ease of movement coming up. Now we're not getting that. But also in the volume. We can box that volume in and we can say this volume is just not in keeping with the prior rallies that we've seen in this market, the prior recent rallies. So we're beginning to construct a story of distribution here, okay? Or at least a lack of interest to the upside. We come back down here to bar number 9, and we get support in the market. But notice that at 9 we actually go a little bit lower than earlier. Kind of a spring here, not a real strong spring. We're not closing on the highs, and we're not seeing a good move to the upside. As we come up and back into the highs of the prior rally, notice what happens on bar 14. Look at the volume that comes in and look at the poor close. Right? As it's trying to go up, somebody's stepping on it. Somebody's selling into whatever buying exists here. And buyers, if you think about it this way, buyers have an opportunity at 14. They have opportunities at 4 and 6 to bring this market up higher, but they're unable to do it. Okay? And by the time we get over here to bar 19, there's just no ability to rally up any higher here. Wyckoff called this area in here the primary distribution. This area in here primary distribution, and this area in here secondary distribution. Now we're going along a sideways line. Let me erase this so that it's a little more clear. We're now coming along this sideways line of February and March here, 2 months, making really no net new progress to the upside. We've seen evidence of supply, and we've seen evidence of an inability to rally and a lack of demand coming in. Okay? And the market begins to fall. Now, We were talking earlier about high volume, ultra high volume here, and even narrow spreads. I was going to mention this earlier in David's presentation. We're breaking out of a trading range. The odds are good. Sometimes this won't work out, but the odds are good that when we're breaking through a trading range and we see that increased volume, there'll be continuation to the downside in the direction of the breakout here. Okay, that's the odds. The probabilities are higher that we're going to see this drop and go further to the downside, and it does. We come down again. We hit a support level. Wyckoff was the first one ever to talk about support and resistance, and we get a little bounce off of that. But look at the quality of the rally. Look at these last couple of bars here. Bar 20, 27, and 28. And look at the volume. There's just no ability to rally up here. Okay? Here's a current chart or a recent chart of the S&P 5-minute on a 5-minute basis. You see the same kind of thing. We rally up, closes begin to, we get a little clustering of closes up here, a shortening of the thrust, no ability to rally up. As we come down here on B and again on C, we see increase in volume, right? And as we try to rally up to D, it's that lackluster kind of rally. Volume is receding on the rally. We try again to move up. And it looks like maybe on these last couple of bars here, bar 2 and 3 in from the right-hand side, that we might try to rally up. But it's by the time we get to E and that paints a close, it's just showing that there's really no ability to rally. Again, we see that sideways line that occurs, and there's the result. We drop down, and this market runs for 10 points or so, which is not bad in the S&Ps. Right? Although recently the volatility has been pretty high. Everybody see that? Yeah, go ahead, Earl.
If you were to look at, let's say, the volume during the open versus the volume during the close, can you draw any conclusions or?
Yeah, excellent question.
Can you repeat that?
Yeah. Earl asks a really good question. Can we take a look at the volume from the open and the close, and can we make any deductions from it or come to any conclusions about it? What we normally see in the S&Ps on an intraday basis is that the volume has a U shape to it. On the open, the opening first hour or so, volume is relatively high. As we get down towards the noon hour, we generally see volume get really small, right? Volume, and then towards the end of the day, as traders are flattening out, we'll see that volume begin to expand again, right? You can call it the volume smile. It looks like that kind of U shape, right? When we see abnormal volume in the middle of the day, that's usually an indication that something is potentially changing. And here we kind of see that at B and C. We see a few abnormal volume pops coming in to the downside. So it's giving us a little hint, even though we're going sideways and this is the noon hour and there's not lots of trading during the noon hour. And I'm using the New York time zone as the time zone here, Eastern Standard Time, New York time. Usually between 12 o'clock noon time, Eastern time, and 1:30. It's what we refer to as the noon hour. So when you see abnormal volume in the middle of the day, that can be significant. Okay, and it was here. Good question. Here's another example on a 5-minute S&P chart of distribution. I'm pretty sure I have yeah. Again, I'm looking at the volume here. And this comes from David's wave chart. This is another way to look at it. We get a nice move up off the morning, and we have good volume coming into the upside. the first reaction, volume recedes. We see that. We rally up. It's not a great rally. Volume is beginning to diminish as we go higher. We react a little bit. We take another rally. We make another rally up, and look at the volume here. Just no volume. And then we come down. Volume increases to the downside. We try one more time to rally up. There's no ability to rally. And bang, we come down. And notice that the volume increases. So if we go short in here somewhere and we see this volume increasing to the downside, we can hold that position into the close, because the odds are good that we're going to see that continue down. Okay? So this is just looking at volume, looking at this rallies and reactions, assessing the volume, and how the market is behaving on each of these rallies and reactions to give us clues into the market for, in this case, distribution. And remember, this is a 5-minute chart of the S&P E-minis. It's the market that I like to trade the most. So as Gary Fullett had said yesterday, we're not looking for a month's worth of downside here. This is a 5-minute chart. So 8, 10, 12 points in the S&Ps on an intraday basis is a pretty nice run. Yeah. Sure.
I see why you're looking to go short up in there, but could you maybe speak to how you pick the price you're actually going to sell short at?
Where would I sell short? Yeah, good question. You can do it in a number of ways. We would draw off the top here a trend channel or a horizontal trend line, and we would take the first low that was made. Here's the first high. I'll just put that as number 1. The low immediately after that would be number 2. So we would draw a horizontal line indicating our resistance level at 1, and we would draw a support after 2 has been painted and it starts to turn up. We would draw a horizontal support line. Okay? As it comes, we don't get an upthrust up here. It just goes up and tests this area, what we would call a test in Wyckoff terms, a secondary test. Fails to go higher at that point, comes down, breaks down through. Remember David's little model of where to find trades? This is exactly it, right? We break down through and then come back up and try to test this, and we're doing it on low volume. And here we get a couple of weak bars right at the resistance level that we would expect. As we broke down through and then come back up to test that breakout, that's where we would look to go short.
You're going to set an order out there at the resistance or just below it maybe, and give yourself a couple of points worth of stop? Or?
As if I were looking at this at the time, let me just erase this so we can see it a little more clearly. I would go short on either of these bars here, either of these 2 bars, and just go in and put a stop up above it. Yep.
There's an uptrust right at the edge.
Right here, yeah. It doesn't upthrust the actual top, but it does upthrust this lower level. That's right.
And then the second confirmation of the uptrust is right at that edge where you have those 2 dots.
Right, and we get another confirmation.
Like in the 3-minute, for the 5-minute, we're going to look at the 3-minute, but it'll be right there.
Yep. Let me go back up here. Here you can see it. What Franklin was talking about was that we see several signs of weakness here. Although this does not upthrust the top, it does, if we were looking at this on a smaller time frame, we would see that there was some effort to rally here, but it fails, and this bar on this level takes out the buying that occurred on the prior 3 bars. So that's and it closes down on its low, and volume is coming in on that. So it's indicating that supply is there. And that's another spot you could, if you were a little more aggressive on your trading, you could take it as it's coming down from here. Okay? There's enough weakness in this chart, looking at this, where you can begin to see it. You can begin to paint that story of weakness and supply coming into this market. And supply overcomes this market on the move down. Okay? So a couple of places you can go short. One along in here a little more aggressively, But as we've been talking about framing this market out, looking at the structure, the second place to look for it would be right here. Yep. Good observations.
Gary?
Yep.
Sebastian's in here as well, so you might want to say hello.
Hey, Seb, how are you? Nice to hear you. Nice to see you're in. What did I just do? Did I just lose?
Got it?
Gary, I have a question for you.
Okay.
Would you have a pyramid? Would you try to pick resistance towards the top, and then again when it's breaking through that lower time?
Yeah, if I had taken that aggressive trade earlier here and it started to pan out and I was reading this market coming in, sure, I'd consider adding to that position. Absolutely.
Is that part of your trading plan, or in hindsight, are you just saying that you do that if you want?
Well, you would want to make that as part of your trading plan. You'd want to have that specified. You either, you would want to have certain situations where you might want to add to your position. So, for example, you are seeing a lower low being put in, okay? Let's assume that you took this trade up here, and part of your trading plan would be to add to the position if we've made a lower low and then a lower high on weaker volume, okay? So that you're, in other words, you're defining a trend of lower lows and lower highs as you're involved in a trade. So you could do that. But you should spec it out in your trading plan, no question. Good question. All right. Here we see the spring 2000 top and then the subsequent decline into 2002. The same picture emerges, doesn't it? It's the same thing that Wyckoff was talking about earlier. We get that move up to A, but it isn't sustained. As we drop down now to B, bar B, this is kind of breaking the backbone of that rally. And then we go sideways for a while. We try to rally up to C. Look at the volume. It's not anywhere near in keeping with this volume level that we saw on the drive up to A. Okay? And then we start coming down from here. Here's a stock, ABT, a healthcare stock. Healthcare has been a little bit weaker. The same kind of situation, the same kind of distribution situation that comes in. I won't go through all the details here, but you can see that volume is coming in as we come down, right? As we drive down, volume increases. As we try to rally up, volume is just not there, just not there. And then we start down. Back to the 31 market. In a downtrend, and we ended right about here, I think, the last time we looked at this. In a downtrend, Wyckoff talked about rallies emphasizing weakness. And as we try to rally up, there's just no ability for the market to rally. Volume and the spreads and the price bars are just showing that we see no ability for demand to come in. Okay? And in fact, as there is no ability for demand, as buying is seen not to come into the market, when the market starts to fall again, we see supply increase, volume expand to the downside, meaning that this is just liquidation coming into the market. Okay? This is looking, as David said, it's not, price doesn't move in terms of daily price bars or 5-minute price bars. They tend to move in buying and selling waves. And this is the way Wyckoff looked at the market. I'm trying to show you that in this way here. Again, here we are on a 10-minute chart of the S&Ps. We come down to A, volume increases. We try to rally up to B. Notice that volume is just not in keeping with any kind of rally ability here. It tries to rally up a little bit, but then falls off. We come down, same thing again. We draw our trading range in. As David suggested, we break through that here to D on C and D. We rally up. If the rally is weak, we can look for a position as it comes back up to resistance and then back down again. Make sense? So we were looking at this on a daily chart when David showed it. Here's a 5-minute chart. When we're in a downtrend, we want to assess the rallies. Look for them to go into what had been support along here at A, which is now turned into resistance. And we want to see them go up on narrow spreads, relatively poor closes, and receding volume. We want to see weakness on the rallies, and that emphasizes supply. Okay? Another way to think about this is that when we look at the rallies in a downtrend, we're looking to disconfirm that buying is present. Okay? We tend to want to confirm. We tend to want, if we're short, we're looking for moves down on increased volume. I'm suggesting think about it in a little bit different way. Look to disconfirm the evidence of buying and demand if you're short. Here we are, Goldman Sachs on a weekly basis off of the 2007 high and into the 2008-2009 bear market. Again, I just highlighted the rallies. The volume is just not there. Just you see it on all time frames. Okay? So we've looked at it on a 5-minute chart. Here's a weekly chart. Back to the 31 market. What does this look like here at A and then B? What are we seeing here? Go ahead, Earl. A little bit of a bottom reversal potentially, right? Yeah. What are we seeing at A? Volume's coming in a little bit, that's right. But the price bars, what do we notice about the price bars as we're coming down? Are we getting good movement to the downside, or are we kind of beginning to see a little shortening of the downside thrusts here? Right. Closes are in the middle. The lows are not making the same level of progress as, say, we were up over here, right? As we were coming down, or over here as we're coming down. So we're starting to round under a little bit. And then we get a rally coming up. So the question then is this short covering? Or is this maybe a reversal off the bottom? And are we going to see a good rally here? Well, let's take a look. As the market goes up, we're not seeing a huge increase in volume here. And the very next bar after B tries to rally up and then comes back down and actually closes lower than that push up from B. And then as we try to rally more, notice the volume. What's it doing? It's coming down, right? So is this something we need to be concerned with? No. The rallies emphasize the weakness. Okay? And if you were inclined to pyramid, we have a little bit of an upthrust right here. You can take that as an additional stock position. Again, on D, as we come down to this level, volume increases. We expect volume to increase if we're going to break through that support level. That means more supply is coming in, and that's exactly what we see. Right? And volume is increasing again as we come down. We saw this chart yesterday. I presented this chart, but it's a similar idea. We're moving down. We see a little buying come in at A, but as we rally up, we're not seeing volume come in. We drop down to B. Here we see more volume, but it's downside volume, right? Some buying comes in, it turns the market around, but again, we're not seeing good, solid volume coming in to the upside. Again, the weak rallies are emphasizing the supply that exists in the market. And we don't get climactic until we're down here at C. Then volume starts to come in. We see that here, and then it gets tested. We talked about buying climaxes yesterday. And here on the next chart, I just highlighted it in with the boxes again. You can see it a little more clearly when you do this. It really does help to think this way. You can see that volume comes in on this rally compared to any of the other rallies that we have, right? So that's a change in behavior, and we would expect now the market to rally up. In his studies in tape reading, Wyckoff, and he used the pen name Rollo Tape, he said the study of responses is an almost unerring guide to the technical position of the market. And that's really what we're looking at here. How's the market responding to this rally? How's the volume responding? Is it coming in or is it not coming in? What about on the downside? Okay. Oh. Here again, we see Goldman Sachs. We see some buying coming in clearly, but then the rally just doesn't give us much, and we come back down again. Again, buying comes in, but we're not seeing much coming in on the rally, and this market continues to drift lower and lower. Back to the 31 market. Here was what we were just talking about. Notice here, look at the difference here. What do you see that's different here that we didn't have at A and B? What do we have at C, D, and E that's giving us an indication that there's real buying coming into this market? Go ahead. Range of the bars are wide and they're closing near the highs. Right. What else is going on, especially on D and E? And even C. The volume's coming in, right? On C, notice the narrow spread and the lack of really good progress, and yet the volume on C is higher than the prior bar, right? Somebody's stepping in and buying at that point. The very next day on D, we see buyers step in, and they have erased all the selling on bar C and the bar before that, and even it looks like the bar before that, or close to it. They bring it back up to that level. And they do so on good volume. And there's follow-through the next day on bar E. We see more buying come in. Granted, the range is more narrow, so there's some selling in there, right? And the volume isn't quite as high. But compared to the other volume that existed here on the upside, we're seeing buying coming into the upside here. Change of behavior. And we come back down here at F, notice the volume here. That's confirmation. We're seeing a testing going on. Okay? And yep.
Can you go back to that last one?
Mm-hmm.
I get tricked up by looking at bars A and B. So I'm thinking there's going to be a reversal at some point.
Right.
And if you look at the first bar of that day, the 27th, closes toward the high,
Mm-hmm.
big volume. You think, okay, so there's some buying coming in there. You also see bar B that goes up on big volume. Apparently there's a lot of enthusiasm there.
Right. Some news probably hit, right?
And then even when on the 11th, as it's coming back down, the volume comparatively is much less. And even toward the end of the day, we get on the 11th that big volume bar, and the close is hardly off. I would be wrong at that point. And the next day, I get caught out because it's going to stop.
Right, right. Well, and so you're asking me so you would be seeing this as buying coming in here, and you would be looking at this bar that I've highlighted. This looks like you would, I guess, think about this as a test because the volume is light here. Is that right?
A lot of times you see volumes come in on A and B, and then it comes back down. I think Tom calls it slam strength 6. Comes back down and retests that area.
Mm-hmm.
And previous to
Right here?
on the 11th.
I'm looking at the 11th here. This.
The last bar is the 11th.
He thinks that there's a weekly volume.
This is the 11th here, right?
That's only one dollar.
The 11th is only one. I'm looking here. This is May, and this is 11.
Oh, okay.
He's thinking there's more bars to the 11.
The 17th.
17th.
Yeah, right there.
This here.
Yeah. So that could be seen as sign strength 6.
Look at the volume on this.
Right, on the 16th, where there's big volume,
And what do we say as price approaches a support level and volume increases? What are we seeing there? This is, if I'm looking at this bar here, right? Is that the bar we're looking at?
yeah.
Okay, here's a line. Here's a weekly line, and that comes down to here.
Right, that's huge volume. Here, but then the next day after that, looks like it's being tested.
No, if we're talking about this bar right here,
Correct.
this is the volume on that bar, right? Is that correct? Okay. This bar is coming down into a support level from A and B. We would draw a horizontal line there, right? And we would draw another line here, but we're coming into a support level and we're seeing high volume coming in, okay? And typically we're in a downtrend, right? You're thinking that the next bar, because it's low volume, is a test?
Well, I'm thinking that that high volume bar we're talking about is just off the low, and then the next bar, it tries to go down, can't make any effort to go down, volume less than previous to. I'm wondering, could there not have been buying in there, had I not known the right side of the chart, what's happening on the 18th and on, I might be tricking myself thinking,
Okay.
okay, there's some buying there. It doesn't seem like there's any ease of movement going south.
All right. Okay. So let's take this apart. And just for the folks on the internet, the question is this. When we see this bar that I've just highlighted, even though there's high volume here, it's closing a little bit off of its low. And then the next bar is volume less than the previous two, and therefore we could interpret that potentially as a test. Go long on that and then be killed, right, with that position. I get stopped out on that position. Okay, so let's talk about this. What's happening as we approach this support level? What's going on with the volume as we come down here? Volume's increasing, right? Now, it's hard to draw a horizontal line, and I'm not sure whether this close is above or below that line, but the next bar is actually down lower, and it's a very narrow bar. It's probably one of those Saturdays, right? It's an inside day, and it's also, from what I can see here, it's below that support line. I'd want to see, potentially we would see that this is, in a spring position. But there are a few things that are working against this. Number one, volume's increasing as we're coming down. Number two, we're in a pretty good downtrend. Number three, we haven't really seen buying come in. Yeah, a little bit of buying has come in here, but it was immediately erased, in fact, on the very next day, and then a pretty weak rally. Unlike, I'm trying to contrast these two areas, here D and E and C, buying coming in here versus this area at A and B, where there's really not a good evidence of buying. But had you seen that coming down, you really want to wait, especially if we're in a downtrend. Remember, David said springs in a downtrend are really, they fail an awful lot. Both Gary and David say that, and I concur with that. They really do. We want to see some kind of evidence that buying has come in and closing back up above that support level. We're not really seeing that here, okay? And this is one of the things that we talked a little bit about, that and Tom Williams talks about this, and so does Sebastian and everybody else too. you can see that as volume less than the previous two and a potential test, but we're in a downtrend, right? I think there was a CD that was produced a while back about polar bears and Hawaii or palm trees in Alaska, right? It doesn't really fit. We need to keep in mind the background conditions, to put it in kind of VSA terms. We need to keep in mind what's going on in the background. And we haven't really seen evidence of demand here come in. So that volume less than the previous two, it exists, and from a purely technical point of view, it would be, you could call it a test-like bar or a test, but it has no real bearing on this market here. Okay. Another way to think about this is that one swan, a capistrano, does not make, right? In other words, if we see one bird coming into the swans coming back to Capistrano, we don't say that they're all coming in, right? We need to build evidence. David, one of the things that he taught me was to build a story, a Wyckoff story, before I go in and take a trade. And I haven't got a story here. Right? In other words, the story of who's really in control here. Have buyers stepped in, or are sellers still in control? And you would have to say that sellers are still in control here. Even though you have that last bar that looks like a test and it's light volume, we still haven't had real evidence. When we think about a change in trend, and we're in a downtrend, here's a different way to think about it. Buyers must prove themselves, okay? Because the momentum is to the downside. So buyers have to come in and prove themselves. Same thing on the upside. If we're in a good uptrend, we need to see sellers prove themselves, okay? Yeah, Craig.
Maybe you could talk to this, being a psychologist, because I find it's just the case with us as human beings.
Mm-hmm.
The problem is we want to, people want to buy the low. They want to counter trend trade because it makes you feel so smart.
Right.
I got the low. I
Right.
sold high. But it's so much easier to trade with the trend. Can you maybe talk about? It just seems to me that we as human beings carry around some baggage.
Right.
That predisposes us to do bad things.
Craig Russell from eSignal makes a good point. He said, from a psychological point of view, we're looking to satisfy our desire to get in at the bottom tick, to go long, or to sell at the high tick. And it's true, we do. That's an ego game. And I often think about Marty Schwartz. Have you all know the Market Wizards and the New Market Wizards books that were written by Jack Schwager? Really excellent books. And if you haven't read them, I would recommend reading them, because they're just a bunch of good war stories, and you begin to realize that sort of what I was talking about earlier about the deliberate practice. Nobody, I think, out of, 25, 30 people that he interviewed over those two books, one person was good out of the box, and everybody else was a failed and lost money and lost large amounts of money. Marty Schwartz, I never met him. I'd like to, but he worked at this for 10 years, and finally turned it around. Schwager says to him in the interview, "So, Marty, what was it that helped you turn yourself around, going from a net loser for a decade into a profitable trader?" And he said, "It was when I stopped wanting to prove myself right." He said, when making money became more important than being right. He said, before I would figure it out, and I would say to myself, I'm right, and he would basically kind of force his will on the market. I'm right, and therefore I'm right, and I'm going to stick with this trade, and he would get punished. And then he, enough times that occurred, and he realized that a few other things went on too. He finally made a plan for himself after 10 years, but he also realized that being right had really nothing to do with being a successful trader. David talked about Mark Douglas's book, which is another excellent psychology book. We're talking about probabilities. if something has a 70% chance of winning, a probability of 70% as a winner, well, it also has a 30% odds of losing. Okay? It's the flip side of that coin. We're in a probabilistic field, and being right has nothing to do with it. Making the right decision at the right time has everything to do with it. But being right or being wrong is immaterial. Remember, anything can happen in the market, and it often does. Mark Douglas also says you don't have to know what's going to happen next in order to make money in the market. In other words, to put it in Marty Schwartz's terms, you don't have to be right in order to make money in the market. Your ego doesn't have to get into the middle of things. Okay? Hard for us, right? Because our ego is always there. Our self, we want that. And we have trouble taking losses. And I mean, we can go on with that for quite a bit. Remember David's model of where to find trades. Is he trying to sell the top and buy the bottom? Well, in springs and upthrusts, yes. But if those don't occur, he's not trying to do that. He says one of his favorite trades is when we see a breakout come through and then it comes back up and retests. Right? That's the place he likes to take a trade. So it's not trying to pick the absolute top or the absolute bottom. It's all about making money and finding those locations. And he gave you a great map of where to find trades. I would really encourage you all to study that because it's marvelous. And think through about how that applies in different market situations. Because it describes, he didn't talk much about it, but it describes the market, period. And sit there for a bit of time and just think through with that little chart, and you'll begin to realize how much that really says about a map of where to find trades. Okay? So, trying to, if you know, in a situation like this, it's a hard one to be buying at the low here. Yeah, we want to try to do that. We want to satisfy that ego drive of ours to say, yeah, we bought the low. You know, I mean, here's another way to think about it. Choice A, I bought the low tick. Choice B, the clouds are coming, the birds stop singing, it's probably going to rain. Which one is more appealing to you? Think about it. You don't have to answer this, but just which one is more appealing? I bought the low tick. The skies are darkening. The birds stop singing. It's probably going to rain. Trading is choice B. It's not choice A. We want to buy that low tick. We want to sell that high tick. But really, we're much better focusing on the process of things. Where the clouds are coming in, we notice the birds stop singing. Okay, let's take our umbrellas out. That's trading. Okay? All right. I went off on a tangent there. I apologize for that, but I hope that's...
I think that was 100% completely relevant, though, to exactly that discussion. I mean, we go back to Gary's other presentation from yesterday with Wyckoff, and I'm nowhere near a Wyckoff expert at all, right? But 5 steps to Wyckoff trading: determine the trend and position of stock or commodity. That's number one.
That's number one. Yeah. Craig is just saying that this discussion is nicely relevant, and it ties back into Gary Fullett's discussion yesterday, where step 1 of the Wyckoff method is to determine the trend and act in accordance with that trend, and that's what we're talking about here. Okay. Let's move on then. Reversals often, we don't see a reversal just turn around overnight, which is kind of what that last question was. Well, we're coming down to support in a downtrend, let's buy it. It takes some time. Here's a 60-minute chart, or 120-minute chart of the S&P E-minis. And this is the mid-January high here. and we fell down into February. We have a little climactic action here at A. Look at the change of behavior here. This is the kinds of things that we're looking for before we begin to think about taking a long trade in a downtrend. Do we see any bar like A in this downtrend? We see wide spreads here and here and here. We see a wide spread here as well, but more wide spreads here and here. We don't see anything to the upside. Everything is pretty, we see one bar to the upside. That's right here. Everything else is coming to the downside. And then we see this bar A on the highest volume to the upside since the downtrend began on the largest spread or the largest range. Here we have some evidence of potential buying. We come back down to B, and it's the end of that day, and we hold there at B. We rally up. Look at C, high volume coming into the upside. There's buying going on. It comes back down a day or two later into D. It closes off the low, a mid-range close. Nice volume. Again at E, we come down and hit that. I drew in that green slightly sloping line, showing that the supports are lifting in this trading range. And we get a nice bump up in E, and then we come back down finally at F. This is a little bit of accumulation. This is the kind of things that we want to see before we jump into a market. Unless we're going with the trend. Here we're talking about a change in trend. Okay? Here we can see some accumulation coming in. But notice how long it takes for this to occur. Okay? And here's the result of that. We get a drive higher. We expect that drive higher because we see that accumulation area in here, right? It drives higher. And that accumulation area in February was right here. We ended that last chart here. We get a little reaction. And then we drive higher and higher. Until, what do we see here? What are we seeing? Shortening of the thrust. Aren't we seeing, do we see any large down bars on such high volume anywhere in this uptrend since this uptrend began? No, right? We're pumping up and down here. This is distribution, right? And that was what, again, no one knew that this was going to lead to that Thursday huge drop. But we certainly were talking about this as the next leg of this market was wanting to come down. And David talked about that April 26th bar being narrow and up-thrusting this trading range, right? When it up-thrusted that trading range, he already knew that there was weakness in the market just by this. This was the Goldman Sachs day where they came in, news generated, but supply came into the market when Goldman Sachs was allegedly implicated in the credit default, the subprime mortgage mess, right? And they were indicted. And it was news driven, but there was supply there. And we see that because it's the largest move to the downside since we started up. And then that upthrust comes. So it builds a story of supply that we see here, and then an upthrust, right? And then it's confirmed by more supply. Gary's going to talk about this in terms of preliminary supply, and then last point of supply, the more classic Wyckoff SMI approach. Same area. I was looking at his chart. I cheated. I peeked at his charts. He'll talk about that. But just when he does, just remember that there is a story here. There's a story of supply that entered the market that allows you to take that trade at that point. But what we were talking about before, buying because there's one bar that shows less than the previous two volume, that's not a story. It's just a single swan. Somebody had a question.
That Goldman Sachs thing, would that be a manipulation where it came out during daytime options expiration day? Is that like in the middle of the day, it should come out after the close or something? Is it that a manipulation kind of thing?
It could have been. Yeah, it's hard for me to know. I don't know if it was a manipulation or not. It certainly affected the market. Oh, sorry. Yeah, the question was, because Goldman Sachs came out in the middle of the day, was that purposefully done? Was there manipulation there? Oh, yeah, and it was on options expirations, which is usually a fairly volatile day in its own right? Whether it was or not, it's hard for me to know. I don't really know that. You can look up, you can add up the evidence, and you can decide that for yourself. But it certainly had an effect on the market. And I don't know if the lawyers at the SEC were trying to make a point and did it in the middle of the day, or there was a lot of discussion about how Goldman Sachs wasn't even, privy to any of this. No one gave them a heads up. It just kind of hit them blindside. So who knows? Who knows what games men and women play in those high positions of power? I don't know. Yeah.
Sorry, Gary, we were talking about the event last week.
Yeah, Goldman Sachs.
CNBC have cracked it. My wife the reason I've been on the phone and finding this out is it's all been solved, everybody. We found out who's done it. Yep. It was a black swan hedge fund. But then this is CNBC reporting it live now.
Oh, yeah?
But then on the very next page, another reporter reports that it was actually Goldman Sachs and JP Morgan.
Yeah. So we don't have a real... Gavin is saying that there's some... CNBC is reporting that there was a black swan hedge fund that caused the big downdraft in the market. And yet, on the other opposite side of the page, it was JP Morgan and Goldman Sachs.
So you put your microphone, it's only a minute video. Put your mic on there quickly.
Gavin's got a video here. Hang on.
Minute. Let's see if it'll come out.
Exchange stopped. Stocks for 90 seconds. The business went elsewhere to the electronic exchanges, and because the computers saw all the sell orders, it drove the stocks down sharply, and it took the Dow Jones Industrial Average with it.
Yeah, but beyond this technicality, there's fragility in the economic system today. Massive fragility. Massive.
Yeah, sorry, but
that's not quite working, but they're talking about it. Yeah.
Oh, I know why. There's feedback because of that.
Yeah.
Okay. So, yeah, that's the story anyway.
Okay. There was another question here.
I was just going to ask you, talk about building up a story.
Mm-hmm.
Can one bar build up a story? I mean, and I'm thinking more technically, so like if I see a bar that may be closing on a 200-day moving average and is lining up in some time analysis and maybe building up all these different stories. I mean, what's your take on that?
The question is, can one bar build a story? I don't think so. And if you listen to yourself ask the question, you're saying, okay, it's a bar closing in a certain way, but it's also on the 200-day moving average, and it's also, another time frame dependent kind of thing. Markets don't really turn on a dime. We see V-spike reversals about 10% of the time in the market, so maybe 15. So 85 to 90% of the time, there's going to be a transition. And what Wyckoff was always interested in was understanding the transition and being able to detect when the critical point in the market was created, and then to be able to take a position at the danger point to reduce the risk. Wyckoff talked about this in his tape reading course. He said that as we started this, and this is a good way to end this, as we started this two-part series on Wyckoff's 1930-1931 case study, the very first slide I put up was his opening of this case study discussion. And he said, the most important thing to know about the market is the trend. Okay? And then he goes on, and he talks about the New York Times 50 average and the trend. In his tape reading course, he talks about, yes, the trend is the most important thing to know, but you also need to know when there's about to be a change in the trend. And he said this is the way you detect it. When the up waves in an uptrend become shorter, or the down waves become larger, or both, that's the beginning of a change in the trend. And if we look at this, we can see just here, we've kind of been talking around this, but the uptrends here, by the shortening of the thrust, get smaller, or the up waves, I should say, get smaller. And the down waves now get larger. You can see that here, right? Right in this little area. Everybody see that? Okay. All the way up, we have down waves, but they're small, right? And the up waves keep progressively making higher highs. But here it changes. The down waves get larger, the up waves get smaller, and that's how we tell a change in trend. Okay? All right, I think it's time for lunch. Let's see if I'm out of slides. Let's see if I'm consistent. Oh, no. One of the things that I did, I just do this really quickly. We talked about comparative weakness and comparative strength on the yesterday. Here's just a chart of comparative weakness. What's that? Time for lunch. No more waiting. Okay, thank you very much, everybody. I get the message. All right.
Just before we go.
And Gavin's got a couple of words here.